It is good to be with you. Thank you for that introduction. As Cheryl mentioned, there have been some changes in our business situation over the last year or so. Come on up there. There you go. But I still do about the same things I've always done. So, we still do market analysis, and of course, EMI is part of AgriStats. Very involved in the poultry industry over the last 20 years. They have customers that wanted more insights on other species markets, and so that's the reason they came and talked to me. We're in the process of trying to secure a top shelf beef analyst for our company so that we can offer a broad range of analysis for customers. Some of you are with AgriStats now. EMI is a separate service sold by the same company, and so we'd like to talk to you about that at some point, and be sure and talk to us here at this show. We'll be around at some other Midwestern shows. I do want to introduce Matt McKellar over here on the side. He's our representative for AgriStats in this part of the country, and so if you have a large operation that needs some benchmarking to help improve its performance, talk to Matt. We can do that for you. Let's talk about what's going on in the economy here, and the livestock economy in particular. Key factors for this year. Number one is much lower costs than we've had the last several years. We finally caught up with the demand of ethanol, and so we're back into a different kind of cost environment that I think is going to be with us for a while. Now, that doesn't mean a short crop won't cause higher grain prices and higher costs, but we're certainly in much better condition we've been in. PEDV cases obviously was a risk going into this winter. So far, they've developed much like they were last year. We don't see any reason to be adjusting our supply variables at this point based on PEDV losses. Still some risk there, but we're at the end of January, so that risk is not huge, I don't think, going forward. High pathogenic avian influenza, of course, was a big story last year and had a significant impact, big impact on the egg business, significant impact on the turkey business, no impact on chicken. And the thing we were sweating this year was, would we get HPAI into some major poultry broiler producing areas? Well, we didn't do that. We had the break a week and a half ago in Indiana that seems to have been contained. It doesn't look like it's all high path avian influenza. In fact, only one of the 11 farms has been diagnosed as a high path variety. And so we think we're in pretty good shape here, but certainly not out of the woods. I mean, you've got migratory birds that are probably carrying these viruses. The real challenge here is the one that pops up in Indiana is not the same one we had a year ago. And so it's basically a new ball game for the avian influenza situation. MCOOL is gone. Now what? One of the things we're going to watch is imports. And if you look at the Canadian import data, and I'll show you that here in a little while, it's been trending up for a little bit. We've had a pretty big jump in the number of market hogs coming to the United States since Quality Meats closed their plant in Toronto early last year. And that's going to grow, I think, with the stronger dollar. And now we don't have mandatory country of origin labeling out there as this hurdle that packers have to get over to use these Canadian pigs. And so they're much more usable than they were just a few months ago. Demand. We've had 3 really good years for pork demand. And so that says, when is the shoe going to fall? Can we maintain this? Can we keep it growing? Can we just defend the territory we have? I think those are questions that really are pertinent for the years to come. Pork industry productivity is surging. Nothing new about that. It's been doing that for a while, but it's made a pretty good rebound from what the PEDV hits we had. We'll talk about those variables. Exports with a still strong U.S. dollar. We don't see any weakening of the U.S. dollar in the foreseeable future. The rate increase by the Fed in December probably put a little more differential between European and U.S. interest rates and keeps the dollar as the favored place to keep your money. You don't want to hold euros with zero or negative interest rates. And so they're probably going to still be very strong for the dollar. I don't see that weakening anytime soon. So if we're going to increase exports, it's not going to be because the dollar weakens. We're going to have to probably overcome that with marketing efforts and to some degree, lower prices will help us offset some of that stronger dollar. We don't see a lot of lower prices coming in 2016. World competition, obviously still an issue. The Europeans probably are cutting back a bit, but not very much. So the Brazilians' forecast for production there is up. And so we think that's still going to be a factor. Macro conditions, in spite of what's going on the stock market, and we always remind people that the stock market has predicted 5 of the last 2 recessions, so it's not a very good indicator. You want me to let that soak in for a minute? 5 of the last 2. Okay. It is the afternoon, Cheryl, so I thought maybe we whoosh. But we looked at macro conditions. The U.S. economy, I still think, is on pretty solid ground. I mean, we've got unemployment at 5%. It's been there for a while. To me, that's a good number. There's a natural rate of unemployment out there. If you get it lower than that, you start really causing some upheaval in the labor markets. I think this is a good number. Now, I just was upstairs a few minutes ago, and Miss Fiorina and walked in, and you can't swing a dead cat in Iowa right now without hitting a presidential candidate, even though I would like to hit a few of them with a dead cat. As I always point out, I am a Republican. I'm a member of no organized political party. I am a Republican. So, but still, this is a pretty good number long term. And if you stay at 5%, good things are going to happen. The same is true of the U6 rate, less than 10. This is part-time and underemployed, and plus those who don't have jobs. That number was almost 15% in the recession. It's higher than it used to be, but this is more of a part-time economy, and part of that is some uncertainty on employers. If we look, real GDP growth above 2% in the third quarter compared to a year ago and compared to the second quarter, and we've basically been growing at 2 to 2.3% per year for the last 4 or 5 years. I don't think that's a bad number. It's one of those things you can get rich quick, but you can also get rich slowly. And some kind of steady growth at 2 to 2.5%, to me, is not a bad result for the economy. Again, politicians usually don't like that number. The employment data for the last year has been excellent. We added 300,000 jobs in December. They revised November and October up larger. Through December for the year, 2.65 million more people employed than were employed at the beginning of the year. And so all of these are pretty positive things for the macro environment that we're working in. Oil below $30. Now that's not good if you're Exxon or if you're Halliburton or if you're an oil exploration company or an oil production company. But anybody that uses energy, this is great news. It leaves a lot of cash in our pockets that we can decide what to do with. It reduces the cost of producing all kinds of goods in our economy and in the world economy. And so, I still, it's not good to have oil completely fall out of bed, but there's a lot of positives that long-term lower energy prices are going to bring to this economy. Higher interest rates, there's some people saying maybe the Fed overplayed their hand even with that 1.25% increase because some market rates of interest have fallen since that time. It's my contention that the Federal Reserve has been looking at this for some time and kind of sweating bullets and saying, what if something goes wrong and we've got interest rates at 0? That doesn't leave them any bullets, all right? They're kind of out of the fight at that point. And so I believe that they've had a long-term goal of trying to inch these interest rates up. If for no other reason, they're not worried about the economy overheating at this point. I don't believe that's the case at all. But they've got to have some leverage at some point, and they have no leverage with interest rates at that point. The example I give is, what if we had a shooting war in the Middle East? Imagine that. And we may not even be doing the shooting, all right, the way it's gone the last couple of months. If that was to happen, what would the Federal Reserve rate have as far as leverage on this economy? Not very much. And so I think that's really what they've been doing. We look on the demand side that really is driven by these macro factors and consumer optimism, consumer outlooks for the economy, consumer performance index, consumer confidence indexes have continued to trend up over the last 3 years. They're at their highest level since back well before the recession. We look at real per capita expenditures for the 3 major species. You can see we were record high in October. We backed off of that a little bit. November was down from a year ago. That's the first month in over a year that we've been lower than 1 year ago on real per capita expenditures. And this is a measure of the strength of demand. But still, we're up 5.7% for the year for the 3 species. That is primarily driven by consumers' willingness to pay for products. These retail prices have been record high, and we have to remember that demand is not consumption. Demand is the combination of consumption and price that consumers will pay for a good in a market. So the quantity variable is the x-axis, and the price variable is the y-axis, and the question is, where is that demand curve in that space? These data say that that demand curve has been moving upward for the better part of 4 years and are at the highest levels we've seen since the early 90s for virtually every species. When we look at the individual species on a monthly basis this year, beef in the upper left was having a terrific year until November. And in November, they were below a year ago. That's the first time since January of 2014 that real per capita expenditures of beef have been lower. But notice, up 8.4% for the year. Pork in the upper right, since March, we've been just about where we were a year ago. But we're going to end up the year at better than 3% up. And that means that we will have plus 5.5% in 2013, plus 7.8% in 2014, plus 3% and change in 2015. Those are 3 remarkably good years for retail, consumer-level pork demand in the United States. Chicken at the bottom is having a great year, too. They've slowed down the last couple of months, but they're going to have a healthy gain this year as well. So meat and poultry demand is strong. The question is, can we hold the gains we've had? And I think we probably can, given that, in my opinion, the U.S. domestic economy is reasonably strong as well. I don't see a recession here. Again, the whole stock market thing has been predicated mainly on what's going on in China and weakness there. And so I don't think that that's a real bad problem for our business in the short run, at least, unless it has other repercussions. Okay, grain production prices and cost of production. Why are we where we are on costs? Well, this is the big reason. World grain stocks have been built to record levels over the last couple of years. Now, a lot of that grain is sitting in China, the blue bar here, but you can see that even the countries outside of China, stocks are about 50 million metric tons larger now than they were in 2012. And so the whole marketplace is just more comfortable with how much product we have available, and our output has grown as well. We've got corn in the 350 to 385, 390 range really for the next 2 years. Now that's assuming a normal 2016 crop. We think we'll have a few less acres of both corn and soybeans this year in the U.S., but still very affordable corn. If we look on the bean side, record soybean production in the last 2 years, slightly lower coming in 2016, we think, but still ample supplies of soybeans going forward, and that puts meal in the $270 to $300 range for that whole time period. Significantly better than what we've seen the last couple of years. Our cost model right now has 2016 average cost of production at 67. The best producers out there will be $5 or so better than that. We know of producers that have some costs down around $60 on a carcass weight basis. And so when you compare that cost to where the futures markets are now, this is not going to be a bad year. And that's what our conclusion is right now. And you have the opportunity to make it a pretty good year, we think. All right. Let's talk about the other species. They've really exerted a lot of influence on these markets the last couple of years and will continue to do it. First, cattle and beef. The driver here has been profits at the cow herd level. Record profits 2 years ago, lower but still strong profits in 2015. The forecast here from Livestock Marketing Information Center is for profits of about $200 per cow this coming year. So still a very profitable situation, and we have plenty of grass available in the United States. The range of pasture conditions are extremely good anywhere east of the Great Basin. Even parts of the Great Basin are in better shape. Unless you live in California, southern Oregon, you're in pretty good shape, and even those drought areas are getting smaller as we've gone through the winter months. And so there's availability of resources, and there's certainly a very strong profit incentive. And so what have we been doing? Well, we've been holding heifers. This is heifers retained for beef cow replacements on July 1, up 6.5% from last year. That number was about 5.5% larger than the year before. We'll get a number for January 1 here Friday when the cattle report is released. We think that number is probably going to be 5 to 6% up as well from a year ago. And so still building the cow herd as we go through. The flip side of that is very tight heifer slaughter. If we look at the inventory of heifers in feed yards last Friday, as of December 1st, in the report last Friday, there were 270,000 fewer heifers in feed yards this year than there were a year ago. What do you think happened to them? Well, they've got kept for most of those got kept for cows. And so we pulled them out of the slaughter mix. It shorted the market. Prices got high. Feeder cattle prices were extremely high. If you got one on feed, you could feed him a little longer, cheaper than you could buy one to replace him. And so guess what? We fed these cattle way too long. We started back in April and May, running cattle much longer on feed yards. I keep a rolling calculation of the number of cattle in yards 120 days or more. That number's been up 10% or more ever since March. And in a couple of months, it was up 16 and 17% from a year before. So that means you got a lot of cattle that have been on feed a long time. And of course, weights got completely out of hand as we went through this fall. Huge slaughter weights. And about the only way you can ever force that to get current again is the market kind of has to take away all hope to some degree. And that's what we had in the cattle business when we broke these steer prices from 145 and change down into the 110s, about 120 there in September. We've probably all been better off if we didn't have that rally in October, but still, we had to come, get these cattle current, and we're still in the process of doing that. Mother Nature has helped some with some bad weather that has slowed gains down as well, but you can see we're still in this 133, 134 range. We think we're going to move pretty much sideways on cattle prices for most of this year. We have choice cutout values at around $220 average for the year, with the highs right now in $229 or so, and breaking that down into around the $220 range the rest of the year. On steer and hide offal value, this has been a major factor in reducing the value of cattle relative to the cutout value. We're going to see the same thing in a minute in a chart I'm going to show you about the hog business. And why has this happened? Well, a lot of these products are exported. In the case of cattle, you've got a hide that goes from anywhere from $70 to $120, depending on the market, that virtually all of them get exported for processing. So when the dollar strengthens, what happens to that price that those people in other countries pay? It goes down, it retracts from the value of these cattle. Cattle on feed replacements, that report last week, we thought it was mildly bearish, and the reason was analysts had expected this placement number to be down about 5%. It was down 1%. And so they'd expected the marketing's number to be up about 2%. It was up 1%. And so we placed more than what they thought, and we marketed fewer than what they thought. And so it looks to me like we're going to have larger supplies of cattle than what we'd expected as we get into the early summer months. We have beef production up 2% this year, 4% in 17. We think it'll probably be up 4 to 6% in 18 from that number as these cattle, the calves out of all these heifers that have been retained the last 2 years, finally get to market next year. Here's our prices. We got fats in the 130s. Feeder cattle, this will be 7 and 8 weight calves in the 155 to 65 range. And finally, those calves coming off cows in the 3 to 5 weight range, or would be 5 to 6 weight calves at $200 this year. Still very, very good prices. Don't get me wrong, but nothing like the last 2 years that we've seen on the cattle business. So eventually we're going to get some more competitive prices for beef. It'll probably be somewhat of a challenge for pork demand. On the poultry side, here's the facts on the HPAI break. As I've been able to determine this week, I've been watching it pretty close, and there hadn't been much news. It was in Du Bois County, Indiana, southern Indiana, not far from Kentucky. A new strain, different strain than we've ever seen in the United States. So it's not a continuation of last year's situation. It does appear it was of North American origin. The first case was classified as high path. All the rest have been classified as low path. About 250,000 turkeys destroyed, 156,000 layers. The layer farm was not infected, but it was very close to a turkey farm, and they took it out as a precautionary measure. We haven't had any new cases. It's not known to affect humans. Exports from Indiana were blocked by a number of export customers. We expected that. It's not too bad a situation if you get exports from one state blocked, however, as other states can usually backfill those. So we don't think at this point, especially with the kind of quiet nature of this last week, that we're going to see any real major impacts here. The broiler hatchery flock grew pretty dramatically, pretty sharply last year, up about 3%. We think it's going to be slower that the next couple of years. This is a business that's getting close to the capacity of what facilities it has out there. And to grow at that 3% rate, we're going to have to build some new complexes. The last 2 or 3 of those that have been built have run into some local opposition. That's something that the broiler industry is not used to. And so we don't think that they're going to do that very rapidly, and thus we got pretty slow growth. Broiler production was up 4% this last year. We think the growth over the next 2 years is going to be slower because of slower breeder flock growth, plus the fact that we're not going to be growing weights like we have. The big driver on broiler production the last 3 years has been rapidly increasing weights as we went to more and more of these big boning birds. They've got some problems there, though. They've got a condition called woody breast, where some of these real fast-growing birds basically have some muscle tissue atrophy in the breast muscle. It's tough, stringy. You can't chew it. You can't cut it. I mean, it's bad stuff, and it's in primarily one genetic line, but the entire industry is probably going to react to this by taking those weights and not increasing them very much at all this year and next, and possibly rolling them back some on some farms to try to combat this problem. We look, exports were down sharply last year, higher production plus lower exports. We had about a 4-pound jump in per capita availability on a carcass weight basis. We think that's going to be much slower the next 2 years. Now that's good news for us because, broiler availability in the U.S. is going to be not growing nearly as fast as it did last year. That should be positive for their prices. And when we look at broiler prices over the next, our forecast, this is whole birds without giblets or wogs up in the upper left. Some strengthening of prices from the $90 range up around $1.17. If we look at breast meat, we're kind of back to the normal kind of breast meat prices after spending 13 and 14 well out of that range. And leg quarters are just going to stay cheap. I mean, we've had export difficulties there. We're going to continue to have some export difficulties if we keep having HPAI pop up. And so we think leg quarters are still going to stay in this 20-cent range. On the turkey side, we had 4.7% growth in turkey output for this year. We haven't seen anything on this HPI situation that would change that yet. This is a relatively small impact on the number of birds. Unless it grows significantly, we don't see that changing. And so we got production up 4.7% this coming year from last year. We look at exports. The purple line kind of in the middle of this is 2016 export forecasts, significantly better than this last year as we come out from under some of these restrictions that we had, especially for Arkansas. And so we think back to normal on exports. And when you do that, you end up even with the growth of 4.7% relative to history, turkey supplies are not burdensome at all, and we're going to stay very close to record high on turkey prices. And so not a big competitor for pork, but one that we need to probably take a little bit of time to talk about because it was such an outlier this last year. All right, hogs and pork. This is the dollar. And this is the dollar relative to the International Commodity Exchange Dollar Index. It gained about 20% from July of 2014 through March of 2015. And we've been relatively stable since then. You can see it peaked at 100.6 in early December. It didn't really react at all to the rate increase by the Fed, and I think the reason for that was it was expected. It's been talked about a long time. The market really expected it to happen, and so it was already in the market. And so now we're in this kind of range between 93 and 100, and we're bouncing around in that. And we don't think that that's coming down much. We see very few indications of why it would fall, but I don't know that it's going up much either. So when exchange rates are changing is when they exert their real influence, because they mean that whatever you're buying might be cheaper next week. So what are you going to do? You're going to wait. Whatever you're selling might be cheaper next week. Or what are you going to do? You're going to try to sell, and what's that going to do to prices? It's going to push them down. All right? And the opposite can happen too. So you got to think about which side of that exchange rate you're on to see these timing things. Well, that's what was happening between July and March. There was a lot of that going on. But since then, even though the dollar's stronger, we've taken out these timing distortions. And so we'll get adjusted to this. It's going to take a while, and I'd rather not have an expensive dollar as an exporting business, okay? But I'd rather have a stable dollar than one that's changing, too. And so I think that's a better environment. Now, what have we seen on exports? Well, while these were changing, it was not good. I mean, we had a very poor second half of 2014. The first half of 2015 was screwed up somewhat by the port situation that didn't help anything. But we've kind of kept climbing out of that. And in November, our exports were up almost 20% from a year ago. It finally put us up on the positive side of the ledger for year-to-date exports. We think December exports are going to be much the same, probably 20% or so larger than a year ago. You're going to push that number up a little more. We're going to end up 2-3%, something like that for the year. And we see that kind of growth this next year. Now, that's nothing robust, but it's still not a bad scenario for exports going forward. And we're not on this kind of growth curve that we were in the 2000s anymore, at least until the Trans-Pacific Partnership starts taking hold. And that won't happen probably for another 2 or 3 years, and then it's going to be 11 years of implementation in most of those countries that we're going to see some real growth, we think, for Japan and Vietnam and some of those countries in Asia. But we're probably not getting back on that kind of growth curve anytime soon. I would say a victory this year would be if we could get 5% growth on exports, that'd be a good thing. But 5% of 25%, okay, that starts mattering up. That's over 1% of our total production that would go into exports. So we're at about 1% of production more going to exports this year than we were last year. If we look at the cold storage report, we have plenty of product out there, especially if you look at all 4 species. The top left graph up about 20%. We're still up 13% from a year ago, but the drawdown of these pork stocks has been pretty healthy the last couple of months, especially considering that we had record production per slaughter day in December. Okay, that was, second highest ever. So excellent, big kind of production in December, and yet we drew down these stocks. And look how much stocks of hams we drew down, from 240 million down to just 60 million at the end of December. So a pretty good kind of performance in this market of moving product as we've gone through the fourth quarter. I'm kind of optimistic about that. This is a new chart I've just kind of started using, but it shows the stock of the various cuts in cold storage. Ham is the one that goes up the most. We would expect that. It's a very seasonal product. We consume it mainly in the fourth quarter. And we see the drop. Look at the drop on that from this year. We were at record high levels as late as September, I guess. And we've dropped that number back to a very normal. In fact, the third smallest stock of hams on a monthly basis since 2008. You see rib stocks have grown. They grow this time of year all the time because that's a summertime product. So a lot of seasonality, some of it offsetting here. Belly stocks, kind of hard to see. They're kind of an orange line there. Very normal. So I'm not too concerned about cold storage stocks at the moment. I was very concerned about them going into the fall. I'm much more concerned about chicken stocks, which are very close to record large, than I am on the side of pork. PEDV. These are data from the University of Minnesota. And some of you are familiar with this. They have about 26 systems that report data to them. They represent 1,000 sow farms, roughly, with 2.5 million sows. It's not a random sample. It's not a scientific sample, but it represents roughly 40% of the U.S. sow herd. That's a pretty good chunk. And I think it's pretty representative of what we see. Each dot on here represents a weekly total of the number of sow farms that broke with PEDV. You can see that this year's totals are just about the same as a year ago. There's not much difference. We had a couple of pretty bad weeks, 4 cases each week back in November, but that's quieted down pretty well. There were 3 the last week, which would have been week before last, that was reported. But this isn't enough variation for me to start making any adjustments to numbers for PEDV this year relative to a year ago. It's just kind of a normal kind of situation. I would point out most veterinarians that I talked to going into the year expected this year to be a little worse than last year. We didn't think the immunity levels would be quite as high. But so far, it's been about the same. So that leaves me working with the December hogs and pigs report numbers that I've not done any real manipulation of at this point. There's some really important numbers in here, though. All hogs and pigs, 68.3 million. That's record large. We've never had that many pigs in the United States before. I don't think ever. There might have been. No, I don't think so. I don't think we would have back before we had data for it. If we look at the market herd at 62.3 million, that's record large. The breeding herd at 6.001 million. That's the first time we've been above 6 million in about a decade. Up 1.1%, a little more growth than what we expected, but not a lot. If we look at the actual percentage change numbers relative to what analysts reported expected before the report, they're pretty much in line. The only two that have any significant difference are the two lightest weight categories, which was friendly to next summer's futures prices. If we look at farrowings, the farrowing number of 96% for September, November, and the two farrowing intention numbers are small relative to the breeding herd. And this has been a pattern of the last 2 years. So every time the hogs and pigs report comes out, the analysts that I talk to are going, wait a minute. Those farrowings numbers, they just can't be right given the breeding herd. They can't be right. I'm going to talk to you a minute, and I think they are right. I'll show you why. And finally, 10.53 pigs saved per litter. That's record large, up 2.5%, 2.4% from a year ago. And so we're back on the growth curve for litter size. This is farrowings, the farrowings divided by the breeding herd. I guess that's technically not a farrowing rate. A farrowing rate is farrowings divided by matings, isn't it? But still, it's the amount of the breeding herd, the percentage of the breeding herd that farrows each quarter. And the surprising thing to me when I pulled this data up and started studying it was we've been in a downtrend now for about 3 years. You can see it pretty clearly. The only two observations that are not really in that downtrend were in early 2014. They represent revisions by the USDA that were trying to explain discrepancies in the pig crop that I don't think revising the farrowings was the right way to do it. I don't think they should have done that. And had they not done that, we would have a very clear downtrend. Why is it? I think part of it was longer lactations, later weaning by 2 or 3 days. That will affect farrowings as percent of the breeding herd. But I think maybe we're showing up some pen gestation impacts here. As more and more of the breeding herd goes to pen gestation, it's pretty logical to me that we would have a few more sows that maybe we miss for rebreeds. We have a few more litters that don't get carried all full term. And so we see this going down. Now, I don't think that trend is going to go down forever. I don't think it probably will go down very much longer. But still, when you see farrowing intentions, the number smaller than the breeding herd in the next several pig reports, I would say those are probably correct. And I would point out that, if you're trying to predict the number of pigs in the United States using the breeding herd, good luck, because the correlation is practically zero. The issue on predicting number of hogs in the United States is not the size of the breeding herd, it's the productivity of the breeding herd. And so farrowings per animal in the breeding herd, pigs per litter, are far more important than the size of the breeding herd and have been for a long time. And if we look at pigs per litter, here's the chart of that one. You can see the impact of PEDV. We've responded to that and recovered from it. In fact, the last 6 quarters, the rate of growth is almost 3% on litter size. Now, the normal relationship of the 4 subsequent quarters to September, November of 2015 would put us at where the red observations are up there. And if I draw a line through all of those, I'm back on the 2% growth curve. But I've got probably, we think that there's 3 new records for litter sizes coming late in 2016, very likely, and especially with PEDV being no more serious than it is. I didn't mention PRRS a while ago. That same report has some PRRS data in it, and it does show that we've had a little more PRRS this year. I don't think there's any question about that. The 174 strain has been around a bit, but again, it's not way an outlier. It's not one of those things that I probably will do any adjustments for unless we see much, much worse results as we go through February. When I put those numbers together into a weekly forecast for slaughter, the red line is our forecast for slaughter. The blue is last year. Over on the left, you can see the little crosshatches. That's the actual numbers. Since December 1st, the difference between actual slaughter and this forecast, these figures, is 0.05%. I mean, hardly any miss at all. It's bounced around a bit, but cumulative, it's been practically zero. As we go through the first quarter, we think that slaughter is going to be up slightly from a year ago. I'll give you the exact numbers here in a moment. Second quarter, about the same, actually lower than 1 year ago. Third quarter, virtually even. And of course, the fourth quarter is where we have some real concerns on hog supplies going forward. You can see that we have really 8 weeks that are going to be at or above rated slaughter capacity. In practical terms, you say, well, there isn't 8 weeks up there, but those 2 holiday weeks are going to be at capacity too, because you're not going to work the holidays. And we do have some challenge because those holidays fall on Sunday this year. And so not only will we lose that day, we're going to probably lose Saturday and Monday at most plants at a time when we got a lot of hogs to kill. We think that capacity issue is going to be pretty tight this fall. And I think it's very imperative that the entire industry be really current when we get to September 1 or at least October 1 on slaughter on your supplies of hogs in finishing barns, because once we get there, you're not going to have a chance to catch up. We're going to be full enough that we cannot run extra hogs. So fourth quarter we think could be tough. Weights, we think are going to help us the first quarter, be about the same as a year ago in the second and third quarter, and then add 1% to that production figure in the fourth quarter. So not only are you going to have record slaughter in the fourth quarter, you're going to probably add another % to it because of weights come the fourth quarter. And so the market supply impacts of those kind of numbers are going to be pretty negative on prices. Here's our forecast for slaughter. Ours is the shaded one. I put up Livestock Marketing Information Center and Iowa State's numbers to compare to. You can see we've got about 1.7% in the first quarter, down 1 in the second, basically even in the third, and then up 2%, 31.1 million. Record large quarterly slaughter come the fourth quarter. The year only up 0.8%, but still big numbers in the fourth quarter. Compare that over. Lee Schultz at Iowa State has larger growth in the early quarters, not quite as much in the fourth quarter. And the same can be said really for Jim Robb and his staff at LMIC. We think this is going to be pretty backloaded though, as litter sizes grow through the year. For prices, we forecast the national net negotiated price, weighted average across all purchase methods. This last year, 68.49 was the average. You can see our forecast for the first quarter, 61 to 65. And given how January has performed, it's going to have to hustle to get into that range. As a matter of fact, we may be a little high on that one. But we've got the summers up in the mid to upper 70s. The fall, right around $60. And over on the right is futures as of yesterday. Okay, the February contract says, it's offering you a pretty good pricing opportunity for the pigs the rest of this quarter. If we go through the summer, we're at the top end of the range there. We go to the fourth quarter, those October and December futures contracts are significantly better than what we think cash hogs could be in the fourth quarter. And I'll be honest with you, I'm antsy about the 59 to 61. That could be much lower than that if we really get hogs bunched up and backed up in any serious kind of measure going forward. So my thinking right now is that you've got some pricing opportunities that are reasonable on the futures. The fourth quarter is more than reasonable. If you can put together especially an option strategy to buy some puts, perhaps write some calls, write some puts to pay for those from a premium standpoint. The challenge always is with options when you're sitting in January and you want to do something for November, liquidity is an issue and premium time value of that put is an issue too. But so you almost have to do something to help offset those premiums. Packer margins were excellent this fall, $40, $45 per animal. That's pretty big. We know that. But they had a really tough first quarter because of the port slowdown. We think those are going to moderate some. Now, one of the things we're going to see is we're going to continue to see big spreads between the cutout value and the value of live hogs. And the reason is that this drop value is half of what it was a year ago. And that goes into that calculation The packers in the room really don't care where they make their money. They'll make it wherever they need to. But they don't have the opportunity to make the money on drop like they did a year ago, and so they have to get more spread between that. That has some implications for you that might be looking at marketing contracts, especially if you're interested in tying them to a cutout value. Because that drop value is an explicit, important factor in the spread that packers need between those two numbers. So you need to think about that as you're negotiating any changes or any extensions on marketing contracts. When we put the cost that we had a while ago that I said was 67 and change for 2016 along with futures markets, our forecast right now for profits are about $9 a head. The best operations out there will be $10 better than that. So this is not right now, is the forecast, and using the futures at the moment, is not going to be a bad year. You have an opportunity to have some pretty healthy margins on these animals. The tough call is the fourth quarter. You want to lock in something that's a small profit, maybe even not a profit at all, or take your chances that number could be pretty negative. I mean, that's the most difficult call to make when you're trying to manage a business and manage the pricing that you face. Okay, risks. Obviously, the number one risk, and anybody that's heard me talk, this is always number one, is a major export disruption. We're going to export about 22% and change of our carcass pork this year. Anything that stops that for any amount of time would be a disaster from a pricing standpoint, as we would have to let prices fall and try to clear the market here in the United States. It'd be a difficult thing. And so that's small probability, but huge, huge impact. If we look at PEDV impact, that was a risk going into the year. That risk is getting smaller and smaller as I take it as we get through January and getting into February without big blow-ups on number of cases of PEDV. HPAI, same thing here. Not only have we seemingly survived a case of it, we've seemingly survived a case of a new virus. So what does that say about the probability of having the one that was out last year recurring? Really nothing. Okay, so we still have some risk there, I think, on HPAI. We don't see it being a huge price risk on the broiler side. And the reason is this. If we were to get to HPAI in Georgia or Alabama, that's the number 1 and 2 states for producing broilers, we don't think those leg quarter prices can get hardly any lower. There were leg quarters that were rendered last year. There were a lot of leg quarters sold for $10 for a 40-pound box off the back of a truck. Okay? They were getting rid of them. All right? We just don't think they could get much lower. And if you get into those major broiler production areas and you have to destroy several million broilers, what do you think the breast meat market's going to do? It's going to do the same thing turkey did last year. So I'm not sure that it's a bad thing for us, but it's certainly a risk issue that we ought to keep an eye on. Slower demand growth. When you come off 3 years like we've seen, you almost have to have a slowdown. Now, we've seen some slowdown this year. Can we keep it positive for a couple of years? Can we hold the ground that we've had? You know, we've had a major change in the viewpoint of meat. Protein is a positive. Animal fats aren't as bad as they used to be. Even the dietary guidelines that came out officially a few weeks ago said cholesterol is not really an issue. Okay? So there's been a major sea change in consumer viewpoints of these products. Now, will that survive the report from the World Health Organization and all of those kind of things? We'll have to see, but those could be drags. Still, this change of preferences has been a major driver of this increase in demand, and can we hold on to it? We'll have to watch that pretty strongly. Exports, of course, the world economy, the strong U.S. dollar. You know, one of the real problems we have, China and Hong Kong are going to be a growth market. I believe that to be the case. But pork demand there has been pretty soft for about a year and a half. And it goes kind of along with an economy that's softened. And so until we see a little bit of strengthening there, we may not see much growth in China and Hong Kong. Some, but not the kind that we've seen in the past. And I don't think there's anything out there that suggests a 2008 or a 2011 is right around the corner. How much expansion in pigs and chicken? Of course, we've talked about that some. They could go beyond that. I hear of a lot of sows going in. And when I hear that and see those productivity measures, it doesn't take a math whiz to figure out that there could be a lot of pigs, especially in 2017 and beyond. Will we have a surge of Canadian hogs due to the U.S. dollar and the end of MCOOL? We're going to have more. and I'll show you the chart. It's a bit busy. The dark blue at the top is feeder or weaner pigs. Notice that those numbers on a weekly basis have trended up for the last 2 years. Okay? Not big growth, but some growth. If you look at market hogs down at the bottom, the pink lines, again, there've been a bit of a surge this year. The first bump there was because of a strike in Quebec back last spring that forced some hogs that were going from Ontario into Quebec to come south. But that second bump starting in last summer is because of the closure of Quality Meats at Toronto, which took away a major plant, and Ontario is way short of slaughter capacity now. They're shipping hogs to Quebec. They're shipping them down here. I think more of that excess of animals from Ontario are likely to come to the United States in 2017. So when I kind of continue these trends, it's not a big surge. It might be 1 million head of pigs, a short 1% possibly, coming south. I think it's too early to call that yet, but it's something we need to watch out for, especially if it happened to get bunched up and start kind of getting too many of that 1 million in the fourth quarter of this year. We'll have to just watch that very close.